Good afternoon, and welcome to the second in Fairer Finance's Consumer Duty webinar series. I can see people are still trickling in, so I'll try and talk nice and slowly for these opening remarks, just to give people a chance to arrive. But thank you very much for joining us. Today we're going to be unpacking the rich topic of fair value. What is fair value? How do you prove that you're offering it? What does a good fair value assessment look like, and what might not be good enough? And of course, we're 9 months into the FCA's consumer duty world now. Many firms beginning to think about a refresh of their initial consumer duty assessment and fair value assessment. And of course, we've had the benefit of seeing what action and what guidance the FCA has added over the last 9 months in this sort of fascinating area, which is always evolving. I'm James Daley, the Managing Director of Fairer Finance, and joining me for today's discussion are my colleagues, Tim Hogg and Eve McGrady. Tim is a Director at Fairer Finance, and Eve is a manager in our consultancy division. And we're also delighted that we're joined today by Graeme Reynolds, who is the Director of Competition at the FCA, but even better, has recently stepped up to oversee all of the regulators' work on consumer duty, and so is about the most relevant person you could be speaking to about consumer duty and fair value, and we're delighted that he's able to join us today. In a moment, Graeme's going to be sharing some of the FCA's latest observations around how the industry is stepping up to the fair value challenge, after which my colleagues Tim and Eve will be running you through Fairer Finance's approach to assessing fair value. And over the last 2 years, we've worked with lots of firms across the financial services sector to help them understand how to meet the requirements of the consumer duty. And we'll be sharing some of what we've seen and our thoughts on how fair value might evolve over the next few years. After our presentation, Eve will be chairing a discussion with Graeme, Tim and myself, and that'll be your chance to start firing any questions that you have. Please put your questions into the Q&A function, and we'll try and get through as many as we can. We've got colleagues in the background who will be aggregating and trying to draw together themes if we get a lot of them, because obviously we've got a limited time to get through everything today, but we will try and answer as many as possible. I know people are keen to get the FCA's view on a lot of the tricky challenges around fair value. But with no further ado, let's hear from Graeme. Graeme, thanks so much for joining us today. The floor is yours.
Thank you, James, and a big thank you to Fairer Finance for inviting me to join them on this webinar today to discuss consumer duty, and in particular, as James said, the fair value outcome. There's little doubt that the consumer duty final rules and guidance have been one of our most significant pieces of new regulation. The consumer duty is a major shift away from prescriptive rules towards a more outcomes focused regime. And throughout, we've said we want to set a higher and clearer standards for consumer protection across financial services and require firms to put their customer needs first. Now, as a reminder, the duty requires firms to act to deliver 4 good outcomes relating to appropriate products and services. So are the products and services well designed for the target market? Customer understanding. Are those products and services sold honestly, and can people understand them? Fair value, the subject to today. Do people get fair value from products and services? And finally, customer support. Do they receive appropriate customer service? And many of you will have spent considerable effort over the past year or more preparing for the changes that were needed to meet the open products compliance deadline of 31st of July 2023. And no doubt will be continuing to prepare for the closed products deadline coming up on the 31st of July 2024. And I'll touch on that a little bit later. But we know many of you are looking to us for further steers on how to comply with the consumer duty. What do I need to do to satisfy myself I'm offering fair value? How do I assess the extent of customer understanding? What level of customer support do I need to give? These are all questions that we've had asked of us and have had shared with us. Now, while the onus is on firms to satisfy themselves they are meeting the consumer duty, we've sought to provide steers of where we have seen good and bad practice to date. And in February, we published a report on good practices and areas for improvement. To summarise those briefly, many firms have already made great progress on the duty. We've seen firms update pricing models by reducing or removing certain charges, put controls in place for certain groups of customers, simplify language and communications, increase accessibility for vulnerable customers, and be clearer about exclusions from products. And a big thank you to all of you that have already made those changes and shifts. But as my colleague, Nisha Arora, has already said, the consumer duty is not a once and done exercise. And there are clear improvements that firms still need to make to deliver against all of the outcomes. Some firms are still too focused on process over outcomes, and some firms have yet to make a sufficient shift to gathering the data they need to be able to monitor customer outcomes effectively. Firms need to make sure they are learning and improving continuously. The consumer duty represents a shift in how we regulate, and we will continue to share lessons we have learned from our initial areas of focus. But to be very clear, this won't be in the form of ever more formal guidance. This is about achieving outcomes, not detailed process prescriptions. Which brings me neatly to fair value, as I said, the focus of today's webinar, where we know there are many questions around this difficult area on how to assess the outcome. Fair value is about the need to ensure the price a customer pays for a product is reasonable compared to the overall benefit. And we often see examples of poor pricing practices that can put fair value at risk. So just to pick up on a few of those. First, behavioural biases. We see firms taking advantage of behavioural biases that consumers have, such as price walking with steady price increases over time that take advantage of customer inertia, eye-catching upfront discounts that hide the true cost of a product, or attracting customers at the point of sale through add-on products that they might not need. Second, opaque pricing, pricing structures that obfuscate the true cost to consumers. These also create risks of poor value, particularly when consumers are paying for services they don't use or even know exist. For example, some ongoing charges for advice if not clearly communicated. And third, the absolute price level relative to the benefits. There are some products where the price is materially out of proportion to the benefit of the product. Value measures work in insurance has exposed some areas where the claims ratios are very low, suggesting low levels of benefits from the insurance. What should be clear from what I just said is fair value will almost always be considered in conjunction with other consumer duty outcomes. Many of the risks of poor value stem from a lack of consumer understanding about the products or opaque fees. And throughout, we'll be taking a holistic approach to the application of consumer duty, looking at all four outcomes. Now, before I move on to some of the ways in which we are assessing fair value, I just want to dismiss a couple of fair value myths. So first off, fair value is very much not about firms being prevented from making a profit. Profits are absolutely the lifeblood of business and drive innovation and better consumer services. But what's important is those profits do not come at the expense of consumers getting fair value. And second, and I know we'll come back to this following the presentation that Fairer Finance gave, the rules don't prevent firms from using introductory rates, offering different prices for different groups of consumers, or using cross subsidies between different products or services. However, where firms have different charges like this, they must still ensure that all groups of customers get fair value from their products or services. Now, building on these principles, some of the most common questions around how we, the FCA, are examining fair value. And I want to touch on two key aspects: outlier analysis and firms' fair value assessments. So starting with outlier analysis, it's very much a starting point for us when looking at fair value to see whether there are outlier firms within a market, or whether a product or service itself is an outlier against other similar products or services. So there may be a bank whose saving rate is substantially lower than its competitors that should be considering whether that offering amounts to fair value. or a firm whose claim ratios on their add-on insurance products are materially lower than its competitors should be, considering why that might be the case. In both cases, of course, it's possible these might constitute fair value if there are other factors which explain why it is reasonable compared to the benefit. The bank may, for example, uniquely provide additional services such as face-to-face branch support that some customers are willing to pay for through a lower interest rate. But these outliers only provide a good starting point for analysis. We will want to be satisfied with explanations from firms on the fair value of their products, particularly outliers. We're prioritising products and markets where we see the greatest risk of poor value. For example, over the past year, we've intervened in the cash savings market with firms that are paying the lowest rate to consumers. And that moves on to fair value assessments. Any firm, whether it has identified itself as an outlier or not, is expected to produce for each product or service a fair value assessment. Overall, in their assessment of value, firms should critically assess propositions from a consumer point of view with a focus on consumer outcomes. Firms should first identify the right product level and target market for each fair value assessment. So in assessing fair value, I would highlight 4 elements to consider. First, the target market behaviour and characteristics. Firms should aim to identify the target market at the product level and relevant characteristics and behaviour of the target market. This helps to define the second step of benchmarking. And linked to the outlier points I made earlier, it's a good starting point to indicate value. The benchmarks need to be relevant, comparing similar products across the market, including those offered by the firm itself. Linked to perhaps historical patterns, comparing prices with benchmarks where there'd been a historical relationship. But those firms shouldn't rely on solely on benchmarking of similar products to demonstrate value, because the third factor is considering the outcomes for different groups of consumers. This needs to be data-led. Firms should check whether there are groups who may receive substantially worse outcomes due to differential pricing or certain behaviours which result in some consumers incurring extra fees. And the last factor, the fourth factor here, contextual factors. There may be mitigating factors which help explain why a proposition is offering fair value despite what might appear to be higher prices. This could include consideration of a firm's business model and discussion of the cost to manufacture and distribute the product. In all these instances, firms' conclusions on fair value should be evidence-based and data-backed. The data is there to help with that assessment and to be used to monitor the delivery of customer outcomes to ensure they're consistent with the duty on an ongoing basis. Now, firms should be proactive in delivering those good customer outcomes rather than waiting for us to intervene. And firms need the right culture and governance to enable this. We, of course, recognise firms will have different capabilities depending on their size, resources and activities. So while all firms should aim to deliver good outcomes for their customers, their approach to the duty can vary, and we don't expect a small firm to apply the same resources or processes as a large firm. So that's fair value. Now, lastly, before passing to James, Eve and Tim, I'd like to touch on the 31st of July 2024 deadline for closed books, which I'm sure is very much prominent in many of your minds at this point in time. Closed products and services were given an additional year for firms to comply because of some of the challenges in these products in the form of gone-away customers, data gaps, vested rights and fair value. And some of the key themes and areas firms should already be considering are as follows. First, addressing any material gaps in customer data for closed products and services and be able to evidence they're acting to deliver good outcomes. Second, taking action to identify less engaged and gone-away customers of closed products and services and think about how, in terms of support, they can communicate with those customers. Third, taking appropriate action where a closed product or service has vested contractual rights, where they find those contractual rights are causing foreseeable harm to customers. And fourth, rather like with the open book considerations, considering if any groups of customers, particularly those with characteristics of vulnerability, are adversely affected by aspects of the product or service design and experience poor outcomes. And then lastly, on the fair value outcome, firms should be applying it to closed products and services on a forward-looking basis. Some closed book products may be particularly prone to poor value. For example, customers in legacy products might pay higher charges than they would for other products where firms are competing for new business. And this is going to need very careful consideration by firms. I think, though, looking at this, the fundamentals of fair value are, in most cases, little different for closed products as open products. Firms should assess and be able to demonstrate that closed products provide fair value to customers. They should ask where prices are different to open products, why is that the case, and what is the explanation from a fair value perspective. We expect firms to ensure they're on track to comply with the deadline for closed book products and services. And of course, any firm struggling to meet the closed book deadline should very much get in touch with us to explain so and help in the discussion. Now, that covers all I wanted to say by way of opening remarks, and particularly on some of those key fair value issues. I'm really looking forward to hearing now from James, Eve and Tim on the work they've been doing before we get into some Q&A, and I'm really happy to pick up questions that you will have in the audience. Thank you.
Brilliant. Thank you so much, Graeme. Some really interesting, thought-provoking comments there. I can see that we've already started to get a few questions coming in. Please do keep adding your questions into the Q&A through the next section. And then once you've heard from my colleagues Tim and Eve, who are about to run you through some of our thoughts on fair value, we'll move into a discussion with Graeme and a chance to answer some of those questions that are coming in. But with no further ado, over to you, Eve.
Thank you very much, James, and thank you, Graeme. So the starting point before we get into unpacking our own framework really is much like the FCA's good customer outcomes. And as we know, fair value is about much more than the price consumers pay for their products. And the FCA says price must be reasonable compared to the overall benefits of the product. So where are we now? Well, day one of the Consumer Duty involved a lot of scrabbling around for evidence to justify existing business models. And what we're seeing is that day two of the Consumer Duty is generating much more interesting questions, rethinking whole business models to deliver better customer outcomes. So with that in mind, let's discuss our framework for delivering better customer outcomes that offer fair value. And one way of thinking about fair value is to consider the competitive market test. So our customer outcomes in line with what we would expect to see in a well-functioning competitive market. For example, in a truly competitive market, customers can shop around before taking out a product. They fully understand the product they're purchasing and they make decisions in their own best interests. Firms will compete on all elements of price, product and service, things that customers care about, and the product shouldn't contain any gotchas that catch customers out. So let's unpack this thought first and think about customers making informed decisions. So one test we can use to think about whether customers have secured a good outcome is the informed customer test. So either the customer understands the information presented to them during the purchase journey or the application for the product sufficiently, and they make a well-informed choice, or alternatively, the product itself performs well across price, features and service so that the customer gets fair value despite the fact that they're less well informed. Like I said, there shouldn't be anything in the small print that, if highlighted to the customer, would lead the customer to feel that they bought the wrong product. So either way, in these two scenarios, the customer won't end up wishing that they'd made a different decision. We've got an example on the next slide of something that's sometimes called radical transparency. This is from Triodos, and as you can see, they've been very open and upfront about what their current account does and doesn't do. This is a step towards eliminating that potential regret feeling that a customer might have after taking out the product. So as you can see here, for example, they've clearly and prominently laid out that Apple Pay is not enabled and that faster payments aren't offered with this product. So now if we move on to think about benchmarking, something that Graeme touched on earlier, in a perfectly competitive market, the level of product features and service quality would always be commensurate with the price. Lower quality products would be sold at lower prices, and higher quality products would be sold at higher prices, both of which would be fair outcomes for the customer. Of course, we do see that price is still correlated with quality in less competitive markets, but because consumers aren't always capable or motivated to shop around and make informed decisions, it's possible in some financial services markets to sell consumers lower quality products at higher prices. And this means that a fair value assessment must consider whether the quality of the product is in line with the price being charged to the consumer. For example, you can benchmark your product features and service quality against the market and compare this to how your price benchmarks to the rest of the market. We use the market average as one benchmark in this context, and this is what might guide customer expectations for your product as well. So as you can see here in this stylized chart we've created, if the product features and quality are below market average, but the price is above market average, then you may not be providing fair value. And in these cases, it's vital to gather the evidence that your customers are aware of that differential, aware of that potential gap, and that they're still making an informed choice when they choose to buy the product. Otherwise, of course, there is a risk that they're not aware that the quality isn't in line with the price they're being charged. As customer outcomes vary within a customer base, firms need to be able to carry out this analysis, this value assessment at a granular level, thinking about the outcomes experienced by each group of customers, or even customers at an individual level in some cases. And we'll talk a bit more later on about how to go about gathering that evidence. Finally, just to bring your attention to our fair value reporting tool, which can be found on our Insight portal, and this enables firms to check how they compare across those three key factors, so price, product features, and service easily across the market. And now I will hand over to Tim, who's going to take us through win-win business models.
Thanks, Eve. So the third element we see in well-functioning competitive markets is that firms are generating win-win outcomes, both for themselves and their businesses, and also for customers. So this means having business models which are reliant on the profitability generated by customers getting good outcomes. And this leads to empirical analysis to run on your customer level data. And we summarize it as follow the money. And this involves analyzing the full distribution of outcomes. As we know, averages can be misleading as they can hide pockets of customers getting good or poor outcomes. By showing the full distribution of outcomes, you can see which customers are your most profitable customers and whether there are any cross subsidies to think about. This analysis enables you to test which customers are driving your business model. The business model analysis tests whether good outcomes are aligned with profitable outcomes for the business, or whether poor consumer outcomes are aligned with unprofitable outcomes for the business. A simple question you can ask is that if you were to remove the customers getting poor outcomes, would the business model remain commercially sustainable for you? And if the answer is no or maybe, then that's an amber flag that's worth thinking about. We've seen a mix of good and poor practice here. For example, in the consumer credit market, we've seen some lenders analysing profitability at a customer level, while other lenders define very broad cohorts, which end up masking underlying cross subsidies based on repayment behaviour. On the next few slides, we have a couple of quick stylized examples of the good practice analysis that we expect to see in good fair value assessments. One of, if not the most powerful question you can ask in a fair value assessment is who are the most profitable customers and why? In other words, let the starting point for your segmentation be profitability rather than demographics. You can then zero in on the most profitable customers and look at what makes them profitable. Perhaps it's their demographics, which is feeding into a pricing model, or perhaps it's their usage behavior, which is driving extra revenue, or perhaps it's something else entirely. Of course, this analysis would pick up if the business model is reliant on certain fees and charges. As we know, all fees and charges must be proportionate to the service provided, and there have been some well-publicised cases where the FCA has intervened on firms charging high exit fees. We've seen lots of good practice in terms of firms now stopping charging exit fees. And we'd like to see more firms remove those gotcha moments. For example, are you making an extra margin at midterm adjustment? Well, this is something that might be picked up by this kind of analysis. If you were to look at your most profitable customers and see, well, actually, a whole chunk of those made mid-term adjustments. Once you've done that, and bearing in mind that averages always disguise the distribution, a good fair value assessment also looks at outcomes at a cohort level. For example, what are the outcomes for customers with different types of vulnerability? Analysing profitability by vulnerability is another good test for whether your business is delivering good and fair outcomes. Oftentimes we see that vulnerable customers generate less profit or even negative profit for firms. Sometimes we see business models where all customers are by definition vulnerable, but on occasion we see business models where the most profitable customers are far more likely to be vulnerable. It's worth digging into it if you find that in your data. Of course, in principle, there's nothing wrong with generating profit from vulnerable customers, as long as the level of profitability is in line with what we would see in a competitive market. In analysing the distribution of outcomes, a good fair value assessment checks whether and which products and services are really driving the business model. Here we've got a very stylised chart showing how within a current account product, it might be the in-credit balances that are generating the most profit as compared to overdrafts or other fees and charges, which points us to two questions. The first one is, are you comfortable that the customers with the largest in-credit balances are still getting good outcomes? And the second question is stepping back a little bit and thinking, what would the fair value assessment look like in a low interest rate environment? Stress test your fair value assessment to see where changes to external conditions will change the value equation. For example, macroeconomic changes, changes to interest rate, base rate, etc. We've been helping firms do some of this stress testing, and so identify the fair value risks in advance and plan for their mitigation. In the investment platform sector, we'd like to see more emphasis on delivering good outcomes for people with cash balances in their investment accounts. We recently saw one provider remove their account fee on cash holdings, which is appropriate given the interest rate paid on those cash holdings. Wherever you have add-on products, such as insurance or financing options, you need to be aware that the competitive market benchmark could result in quite a different outcome. And that's because of behavioural biases and the behavioural science of how we view add-on products. So have you generated the higher profitability of the add-on product because you have that point of sale advantage, i.e. because customers are unlikely to shop around for the add-on due to anchoring or the endowment effect? Selling products as add-ons can save customers time and effort. But does that rationale precisely justify the exact difference between the price of your add-on product and the price of a standalone equivalent product? And in the context of financing add-ons, compare the cost of your finance to the cost of other unsecured credit products available to the customer, such as personal loans. Can the difference in APR really be justified? Of course, add-on products are often low cost in absolute terms. A high percentage profitability may not translate to a high pound profitability. And it's always useful to translate all your percentages into pounds in your fair value assessment. For example, an insurance add-on may have a low loss ratio, but if the premium is only £10 and it costs £5 to distribute the product, well, then you can see that under some circumstances, that add-on could still provide fair value. Last, it's important to consider the value enjoyed by the customer after the full distribution chain has been remunerated. This is particularly an area where we often see poor practice. We've seen distributors simply ask for statements, one-sentence statements, that the manufacturer complies with the duty, rather than asking to see the fair value analysis. We've also seen manufacturers refuse to provide any fair value analysis to distributors. We've also seen brokers consider their own remuneration, so their own margin, but not the value received by the customer after the whole chain has been remunerated. Particularly with some types of insurance products, you end up with a long value chain, and that paid out in claims percentage gets smaller and smaller and smaller. And what we're hoping that we'll see more of in future is firms stepping back and asking whether after everyone has taken their cut, whether it's still providing fair value to the end customer. That was a very quick whiz through. We have to wrap up some key questions that we recommend you ask in your fair value assessment. If you're answering all these 9 questions in your fair value assessment, then it is we expect going to be a very good fair value assessment. So we'll leave this with you. You'll have all the slides afterwards as a bit of a checklist to go and check off your fair value assessments against. I'll now hand back to James.
Brilliant. Thanks so much, Tim and Eve. So we're going to bring Graeme back in now and move into a discussion. This is going to be your chance to ask questions. So please do carry on putting them into the chat. I can see a few that have come in. Eve will be chairing this part. So Eve, over to you.
Thanks, James. So yeah, while everyone is preparing their questions, let me get things started with one question of my own for Graeme. So we talked a little bit about cross subsidies in our presentation, and of course, these are prevalent in many financial services sectors. So how do you think about cross subsidies? Are they a concern? How should firms think about them when they compile their fair value assessments?
Yeah, thanks, Eve. And I thought the articulation that Tim gave during the slides was very good. I think the first thing to be clear about on cross subsidies is that the fair value rules don't prevent cross subsidies. Differential pricing isn't prohibited under the consumer duty, and firms aren't required to charge all customers the same price. I thought, Tim, that came through very clearly in the bit when you were talking. What then that takes you to, though, is how do you deal with a situation in a firm where there is some form of cross subsidy, either between different products or between different types of consumers? And the first thing I think we would say there is to take a fair value assessment at each product level and start with that and assess to see to what extent that product or service is providing fair value, and then focus in on each pricing group for consumers if we're looking at a cross subsidy between different groups of consumers. And the questions then firms should be asking themselves is very much around whether there are specific cohorts of consumers that are receiving poor outcomes due to the cross subsidy compared to others. And Tim, you touched on that quite neatly. So it might be a case of, are there consumers with vulnerable characteristics worse off as a result of the cross subsidy? Are there significant profitability differences between those pricing groups, and what's the magnitude of harm, both in pounds and sort of percentage terms as well? And once you've sort of got that comfortable and understanding from a firm perspective, then it's about bringing those aspects together and understanding maybe if it's between different products, what's the combination look like, or if it's across different pricing groups, well, how does that change if you start to adjust the pricing mechanisms around it? So really very much just to sort of reflect on that, two aspects. One, make sure you're looking at each product separately. Okay to bring it together, though, if there's some form of cross subsidy that's fundamental to the business model. And then secondly, whether cross subsidies between different groups of consumers, going back to why that exists, how it affects different types of consumers as well. No specific right or wrong answer in those, because every circumstance will turn on the nature of those business models and fundamentals that different firms have.
Absolutely, thank you. And maybe if I could just bring Tim in here now. So we talked a little bit about the example of add-on products and what should you do if your add-ons drive the profitability of a business model. So in the case where if a firm were to reduce the profitability of the add-on product, they might also then increase the price of the core product. So what's your view, Tim, on how should firms approach those kinds of trade-offs?
I think it comes back to what Graeme said in his introductory remarks about exploiting behavioural biases, because we know there are behavioural biases when it comes to add-on products. So in particular, firstly, the endowment effect, you're unlikely to want to shop around again for the core product. And secondly, add-on products tend to be cheap in pound terms compared to the core. So that anchoring and adjustment there makes it look cheap. So you're unlikely to shop around, which means there's a problem with competition. The market in that particular instance is not going to deliver brilliant outcomes for those customers as they do not shop around. So that means you might want to reduce the profitability of the add-on products might mean you want to rebalance and charge higher prices or generate more profit from the core product. But the core product is much more likely to already be in a competitive market, which means you're more likely to be delivering good outcomes. And if you increase the price of the core product, people will be able to shop around and make an informed decision with it. So we're not saying that you can't then increase the price of the core product. If that's in a competitive market and people are making informed decisions and you're meeting the other tests, then that might be the thing you want to do to ensure that people who buy the add-on are really getting good outcomes from that add-on.
Absolutely. And something that Graeme mentioned that I just want to pick up on, maybe James, you can come in on this one about measuring customer harm. So how should firms consider the materiality of customer harm? So, for example, customers who have balances in savings accounts, who are earning minimal interest there, should firms focus more on the customers who are foregoing over £100 in interest rather than perhaps those customers who are foregoing only a couple of pounds in interest?
I think it's got to be a consideration. I mean, I think the theme that comes through in everything we've been talking about today, that creating a robust fair value assessment is about gathering data, showing that you've looked at all of your customers' outcomes from all of the different angles that you can do, and then seeing if anything doesn't look quite right. So, materiality is a difficult one because, £5 can be a lot to a low-income family and more to a higher, and can be a very small amount to a higher income family. However, it's very difficult to understand if you're just a savings provider and you don't have a full picture of someone's finances, exactly where your customer sits in there. And just because somebody has a large balance in savings, it may mean that they're sort of cash rich, but it could be somebody who is living off that for the rest of their life. Maybe it's a compensation payment made to them for injury, and actually earning a very low interest rate could be extremely detrimental to them. But I think that if you're not looking at how it's impacting customers on a pounds and pence level, you're missing something there. Whether or not then you have to go as far as to say, if a customer is losing out more than £50, well, that's the moment when we think we have to go to an extra level. Potentially, I think it depends on the type of product, and but it's about making, it's about not leaving any stone unturned, as I see it.
James, can I just add on that? I mean, I think some of the fair value assessments that we've seen, some of the best ones are those that do explicitly look at those sort of vulnerability assessments within them and take into account these sort of aspects where you're really trying to get to the bottom of, what's the product targeted at in terms of the types of consumers, and how might the rates or the prices that those consumers are being charged actually feel relative to the benefits that they're being given, and then thinking about that in the context of any vulnerabilities they might have. And those are the richest, strongest fair value assessments that we've seen to date.
Great. And we've got a question here in the chat, just building on some of the discussion around cross subsidies here. So someone has asked, what's the FCA view on cross subsidies where these are fundamentally embedded in market dynamics, meaning any unilateral provider changes would be challenging to make without putting at risk the overall sustainability of the product as a whole or ability to acquire new business? So maybe Graeme, you could take that one first.
Yeah, well, I think that goes back to what I was saying, which is that we would expect each firm to look at the sort of product separately, first off, but then also to take into account the way its business model works. So, for example, if there is an intrinsic way in which some of the products are set up that require a cross subsidy between one product and another, factoring that in overall to an assessment of how they are reflecting on how they're providing fair value for customers across both of those product groups. So it's not the case that we've turned around and say, well, that means the whole business model needs to change. It's more about understanding how that fits together and why the firm believes that's something which delivers fair value. And there are, financial services is there are many parts of financial services where there are aspects of cross subsidies, or where there are aspects of some products where there is a need to think about how that fits in the business model. So very much firms should not just think that they have to do everything entirely narrowly. Start from that narrow, bring in the wider, and make sure they're explaining that to their board and then to us ultimately as a result as well.
I think one thing I like to think about is, that ultimately the aim here is to ensure that people are getting good outcomes, not perfect outcomes. It's impossible for everyone to have a perfect outcome. But if you're looking across that distribution of outcomes and you're seeing, kind of as Tim was saying, that there's a slice there who are objectively not getting great outcomes. They're paying more for their credit than they need to, or more for their current account than they need to. Then if you remove that slice, does that mean that the whole product isn't viable anymore? I do think that that is going to be difficult for firms, and you're going to have to work very hard to justify that. And in some cases, the right answer might be to start sort of changing the pricing structure so you can make sure that at the very least everybody's getting a reasonable outcome, and there'll be some people who may be getting excellent outcomes. And that's okay, but as long as at the very least everyone is getting a reasonably good outcome, then you can probably justify it.
Great. And just another question coming through, thinking about segmenting customers and kind of customer behavior, looking at different cohorts. So Peter Cross has asked, in this example, thinking about general insurance, if the cohorts you look at are those who claim and those who don't, in any given period, those who don't claim will inevitably be cross-subsidising those who do. And would you expect this to be addressed in assessing fair value? I can see, Graeme, you're nodding. I'll come to you first with this one.
Yeah, look, so I think a really interesting question about cohorts, because it's one of the things we're seeing popping up quite a bit in the way firms are thinking about their fair value assessment. And we haven't got a prescriptive, these are the cohorts you must look at in your assessments. And indeed, in many different financial services and products, there will be particular cohorts you want to pick up based on the sort of target markets and the types of customers that your product is intended for. So in that example there, insurance, it makes sense that you might want to look at those that do claim more and those that don't claim as much. In cash savings, you might want to look at those that have been with your organization for a longer period of time and those that haven't. In consumer investments, maybe it's something more around the level of assets that they have in terms of their investment. So there are always going to be quite a number of facets that you will look for that will be peculiar to the particular product or service. And then on top of that, there are all the classic things that you would expect one to be looking at to try to understand whether there are consequences between different groups of consumers. So, for example, many of the characteristics like age or vulnerability, income levels, those sorts of things, which are also important to make sure that there are not particular groups of consumers that are finding themselves disadvantaged or harmed through the nature of the pricing mechanism. So again, with that, I say start with the sort of the product and the service, what it's intended to do, look at the types of customers and how that might come through their behaviors and experience, and then also think about their characteristics as well.
Yeah, I mean, I just want to add, I mean, on that specific question around insurance, I wonder if that was a bit of a cheeky one, sort of, I mean, because I think obviously you couldn't define fair value for an insurance customer being only the people who have made a claim got great value from this. Obviously they may have got exceptional value from it, but the real value of an insurance policy is that it's providing that protection for you, and that if you do need it, it is there for you, and hopefully you won't need it. I very much hope I will never claim on my life insurance policy, but that doesn't mean I'm getting bad value from it. So, I would say that probably isn't the right way to think about it in the insurance markets and the right cohorts to look at. However, you do want to be looking at those who are making a claim and making sure that they are getting value through that process as much as the people, who are getting value in a different way who don't make a claim.
Absolutely. Yeah, I'd like to bring Tim on this as well, because I think there's definitely a behavioural science angle here.
I won't go on about peace of mind for several hours, although I could. Just to say that it's listed, peace of mind is listed in FCA Occasional Paper 1 as a behavioural bias. So I think, we've seen fair value assessments that just say, we provide peace of mind, full stop, and that's clearly not sufficient. It's about making sure that people are getting true value from it. And obviously, the reason for doing these fair value assessments is that people aren't in the best position to judge that value themselves. So it's about judging it with all the data and expertise that we have. Yeah.
Great. And perhaps now we could talk a little bit about what good looks like. So Graeme, would you like to share kind of some examples perhaps, or some feedback on what you consider to be an excellent fair value assessment, so that people can get an idea of what they're aiming for?
Yeah, sure. Look, this has been it's a learning process for firms. Obviously, we're seeing many of these for first times as well. So it's important for us to see and learn from those what works well, and to share back with firms about examples of where we've seen things going well and not so well. And we've been trying to put that onto our website as we go. Firms should keep looking on there for sort of examples of that. I think I'd probably pick up a few things. In fact, many of those were covered in your and Tim's presentation. So good benchmarking, absolutely, but only as a starting point, not the only assessment. It's not sufficient just to go away and do a Google search to see where your price fits and then leave your fair value assessment of that. What you need under that is then solid data and credible evidence that allows you to explain why, off the back of the price that you are looking at, you believe that to be fair value. Really clear consideration of customer cohorts based on target markets. We've already just talked about that in the context of cross subsidies, and some of the ones that really stand out, I mentioned this earlier, really stand out are those that have got that consideration of vulnerable customers as part of their sort of cohort consideration. A couple of other bits probably just to draw out from the ones that I've seen is really clear examination of the total cost to consumers, including sort of fees, charges, other costs that might come in over the lifetime of a product as well, not just the sort of upfront cost, and indeed factoring in things like the add-on aspects. And then lastly, not thinking about, as I said in my remarks, not thinking about fair value on its own and bringing in those contextual factors alongside other aspects of the duty. So, for example, it may well be that the particular cost of provision is higher in one firm or for a particular group of customers for a particular reason, but then explaining and looking at how you're using the customer understanding and customer support outcomes to make sure those customers are aware and taking a conscious decision around the purchase of that product, so that they are receiving good fair value and doing that on the basis of good understanding and good customer support. So bringing all of the aspects of the duty together. And I think then once you do that, you get this total picture that then allows firms to stand behind their product offering, the way they're working with consumers in terms of understanding and support, to mean that they start to develop this confidence around feeling that they're offering what we're requiring through the consumer duty.
Absolutely. And we've got another question here just about gathering data and gathering all that evidence that firms need to do to support their fair value assessments. And somebody has asked, where is the line of proportionality in requiring firms to be data-led in conducting fair value assessments? So for firms with small books of business, so sub 5,000 customers or even a few hundred customers, are they required to employ new systems and controls to demonstrate that they're adhering to the duty and collect data in a new way? I don't know, Graeme, if you want to add anything to that.
Yeah, I mean, it's a tricky question to answer without the sort of some specifics in relation to particular firms. But what I would say is, no matter how big or small your customer base, you should know enough about your customers to be able to provide the right level of understanding to meet the consumer duty. You know, it may well be that you have sufficient data already in your organization to undertake those assessments, and if you don't, what is missing? Why is it missing? What would you need to do to get there? What steps do you need to take to get there? Over what time period can you get there? If that's a problem to do in relation to certainly the closed book stuff, for example, because of difficulty in getting hold of customers, that's the sort of thing you should be letting us know now, ahead of getting to the closed book deadline on the 31st of July this year. So yeah, really just making sure you're stepping back and asking those questions and thinking about the right ways to do that. There are obviously many different ways you can meet those types of requirements with different levels of sort of investment and understanding, but it's really important that there is sufficient data behind that to enable firms to take those well-informed decisions.
Thank you. And I'm going to come to James now with this one. So question from Neil in the chat. With average car premiums now at around 1k, meaning that brokers will make £200 per policy, how is it that regulators are putting pressure on underwriters to cap travel insurance commissions at 50%, where the average GWP is £30, so the max brokerage is £15? With medical rating, the cost of providing service is greater than a motor policy, so surely a £1 minimum approach is better than a percentage approach. Interested to hear your thoughts on that one, James.
Yeah, I think Tim touched on this, in some of the slides earlier. You do need to be thinking about the absolute amount that you're taking at each point in the distribution chain in pounds and pence, as well as the percentage of the overall premium. And obviously a 50% commission on a £10 premium, it is very different to a 50% commission on a £1,000 premium. I think, again, to bring it all back to this is about creating the word. I'm not an economist, so the word I get drawn to most when I think about fair value assessments is narrative. This is about telling a convincing story that sort of passes the sniff test. Does it sound reasonable? The answers can't be, but it's always been like that, or they do it that way, or the market's broken. Because actually, if that's what you're coming back to, then you are going to need to be pushing that up and down the distribution chain, maybe reflecting that in your fair value assessment and saying, we are concerned actually that customers aren't getting great value in this market, but the structural dynamics of the market mean that, the only option for us would be for us to pull out of it, and we don't think that would be the right thing to do either. And that's a way of sort of flagging broader, market failures with the regulator. But yeah, I think that the pounds and pence element is absolutely right. And as far as I know, that the regulator isn't generally saying there is a maximum commission level. I haven't heard them say that. Maybe I've missed that. But obviously, I do think that as we get to higher and higher premiums in motor and other markets, we have to think about the impact that's having if everybody's just taking a percentage slice and not basing that in their costs.
Thank you, James. So we've spoken quite a bit about insurance, so let's take a look at savings. So we've got a question here, which I'll funnel through to Tim in the first case. If a customer has an easy access savings account and hasn't transacted for several years or moved products despite multiple communications, what would the next steps be, as they are in a product that perhaps isn't suited to them or targeted for them? So what more can firms do apart from those ongoing communications? I guess this is moving into kind of, thinking about good and fair communication with customers as part of fair value.
I mean, in that scenario, your communications aren't actually very good, or they are an insistent customer and they really just do not care and are just very happy to leave it there, making an informed decision. So I guess if I was advising you on this one, I would say let's get the evidence that they really are making an informed decision. They're sort of actively inert. And I think if you don't have that evidence, then maybe you haven't tested your communications enough. So I think that would be the first step, rather than immediately moving them on to a different product without their consent. But I don't know if Graeme has any additions to that.
Yeah, look, I think we're going to see this issue pop up increasingly as we get into some of the closed products and services from July onwards. And I think there is, as you say, Tim, first off, the real question is how effective is the communication in the first instance, if there's sort of no response. And there is little doubt that in some areas there are clearly some inert customers, but part of the exercise here is to really see if those customers can be reawakened in the process of engaging with financial services. That would make the sector much more competitive. It will make it also far better in terms of the way consumers trust their providers as well. So that's the first challenge, I think, seeing if you can try and undertake steps that really do help to reawaken those customers. And then thereafter, I think then it's a question of, well, okay, having done that, what are the appropriate next steps for you to consider? Do you feel you're offering fair value to those customers, given their characteristics and given their inertia? And that will be a question that turns very much on every individual firm's particular considerations.
I feel much more strongly about people being hit with a lot more credit interest, or rather interest for borrowing, than losing out on potential interest. I'm not sure if that necessarily shines with regulators' view, but when I think about mortgages, for example, and people coming to the end of their fixed term and moving on to the SVR, and particularly in the current interest rate environment, you can go from paying £1,000 a month to £1,800 a month if you just let yourself slip onto the SVR. That's material, very material for the vast majority of households. And we have seen people going as far, admittedly smaller firms, as ringing up every single customer that they haven't managed to get through with emails and letters, and saying, we are going to make sure we rung them as well because this is so material. If it's foregone interest, I think at the very least, you need to have the emails, you need to have the letters. When they log into their online banking, the pop-up needs to go, you're on an account where you're earning a much lower rate. You could be earning an extra X £1,000 a year, trying in stereo. And then, as long as you can see that they're logging into their internet banking, maybe you even send them a questionnaire to ask them why they're not switching. Are they happy not to switch? Then you can get to that point where you can say, we've got the evidence to prove that these customers just don't care. They've got better things to do with their time, and then it's fine. But I do think, if the consequence is that they're paying a lot more interest, that's money coming out of their account rather than missed interest on savings, then I think you have to be even more alert to it, particularly, in that mortgage scenario I talked about.
Thanks, everybody. So time for a couple of final questions before we wrap up. This one is about insurance premium finance. So maybe, Graeme, I'll come to you first on this one. So somebody asked, the FCA has recently commented on insurance premium finance as an area of concern. Why has the focus been on insurer instalment schemes when the APRs and fees charged by the premium finance companies are often well in excess of anything and insurer charges?
So could you repeat the question again? Sorry, Eve, I missed part of it. Apologies.
No worries. So they said the FCA has recently commented on insurance premium finance as an area of concern. Why has the focus been on insurer instalment schemes when the APRs and fees charged by the premium finance companies are often well in excess of anything in insurer charges? And they've added, especially as this is largely due to discretionary commission arrangements, something that the insurers don't do.
Yeah, I don't think I'd probably not appropriate for me to comment too much on that one, other than to say, look, these are issues we are aware of. We've been on record as saying that we're considering what we should be doing next around those. So that's probably all it makes sense to say at this point in time, I think.
No worries. So we've got a question here around benchmarking. So thinking about benchmarking our products using FCA GI value measures seems unbalanced potentially, considering the data from FCA is from 2022, while we're reviewing our products for date ranges in 2023 and 2024. So a question about updating that data. Could the FCA data be updated more regularly? And if there's anything holding this back, could the MI for these cohorts be split out and published separately so that you don't need to wait on data from all the products before publishing updated data?
Yeah, I think on value measures, I think we know that the data that we've brought together there has been very powerful in illustrating where some of the challenges exist. So the more up to date and the better that data is, the better it is for us in terms of assessing some of the challenges, and the better it is for the firms externally as well. So I think an ambition clearly is to make sure we're keeping that as and using that as effectively as possible as part of not only the Consumer Duty work, but also much of our other insurance supervisory work as well.
Brilliant, thank you. So I think that just about brings us to the end of our time today. So I'll hand back over to James to wrap up. Thanks, everybody.
Thanks, Eve. Yeah, so many more questions and so much more we could have got to. So I'm sorry we've run out of time, but I hope you found today's webinar useful. I really enjoyed the discussion, and I want to say a big thank you to Graeme for joining us, as well as to my colleagues Tim and Eve for their reflections. As we said earlier, we'll be making the slides and recording of today available over the next couple of days. And if you'd like to talk to us about how we can support you with your own fair value assessments or get a login for our fair value reports tool, then please do get in touch. Our next webinar on Consumer Duty will be coming up in June, but we'll be taking a look forward at how Consumer Duty may evolve and disrupt business models. So some of the things that we touched upon today. And we'll also be considering how firms can stress test customer outcomes. So until then, thanks so much for joining us today, and bye for now.